Welcome smart traders. In this video, we'll be diving into a crucial concept in Forex trading, breakouts and fakeouts. How to trade breakouts effectively. And most importantly, how to identify and avoid fakeouts, a common trap for many traders. If you're serious about improving your trading strategy and boosting your accuracy, this video is for you. So without further delay, let's get right into it. Let's consider a scenario where a support level has been established, and the price breaks below that support. When this happens, we refer to it as a breakout. After the breakout, the previous support level often turns into a new resistance level. This is known as a support becomes resistance zone, or SBR level. At this point, we wait for the price to pull back and retest the SBR level. If the price shows clear signs of rejection at this level, such as bearish candlestick patterns or a loss of upward momentum, it provides a potential entry signal for a sell position. This setup increases the probability of the market continuing in the downward direction from our entry point. If the price quickly re-enters and moves back above the support, this is typically considered a fakeout. It often serves as a trap for sellers, leading them to enter short positions before the market reverses and moves upward. In such uncertain conditions, it's usually best to stay out of the market. Avoiding trades during these moments can help protect your capital and prevent unnecessary losses. Similarly, when a resistance level is formed and then the price breaks above the resistance level, it indicates a potential breakout. After this breakout, the previous resistance often transforms into a new support level. This is known as a resistance becomes support zone, or RBS level. At this stage, we wait for the price to pull back and retest the RBS level. If the price shows clear signs of rejection at this level, such as bullish candlestick patterns or a loss of downward momentum, it can serve as a strong signal to enter a buy position. This setup presents a high probability opportunity for the market to continue moving upward from our entry point. But if the price re-enters the area below the RBS level, then it was a fakeout to trap the buyers, and the price move in the sell direction. Avoiding trades in such uncertain market condition is always a good idea. Now that we have very good understanding of breakout and fakeout, let's look into some real market chart examples. In this example, we can see that a support level has formed, followed by a price breakout below that level. Once the support is broken, it is referred to as an SBR level or support becomes resistance. At this point, we wait for a pullback to the SBR level. If the price shows any confirmation of a selling opportunity at this level, that will serve as our entry signal for a short position. This setup presents a high probability scenario for the price to continue moving downward. If you haven't yet watched my video on confirmation candlestick patterns, you can find the link in the top right corner of the screen. Once you entered the sell position, place your stop loss above the high of confirmation pattern and target the next support for take profit. In the next example, the price broke above the resistance, which subsequently turns into a support level, commonly referred to as an RBS or resistance becomes support level. At this stage, we wait for a pullback to the RBS level. If there is any confirmation or evidence of buying pressure at this level, it becomes our entry signal for a buy position. This setup offers a high probability opportunity for the market to move upward from our entry point. Place your stop loss below the low of confirmation pattern and target the next resistance for take profit. In this example, a support level is formed, and the price breaks below that support level. The breakout appears to be confirmed when candles close below the support line. However, the following candles quickly re-enter the area above the support level. This indicates that the breakout was false, a classic fakeout. In such uncertain situations, it's best to avoid entering any positions, as the price action lacks clear direction and reliability. In this example, we can see that a resistance level has formed, and the price breaks above the resistance. The breakout appears to be confirmed when a candle closes above the resistance level. However, the subsequent candles quickly re-enter the area below the resistance, and there is no confirmation of continued upward momentum. This indicates that the breakout was a fakeout, a false signal, and highlights the importance of waiting for strong confirmation before entering a trade. So no trade is the best trade when there is uncertainty in the market. Now, let's understand breakouts and fakeouts within channels. Consider a bullish market where higher highs and higher lows are forming within an ascending channel. When the price breaks below the lower trend line of this channel. Once the breakout occurs, we wait for a pullback to the lower trend line. If we observe any signs of price rejection at this level, it can serve as our entry signal for a sell position. This presents a strong opportunity to open a sell trade, as there is a high probability that the market may reverse from its bullish trend to a bearish trend. However, if the price re-enters the area above the lower trend line after the breakout, it indicates a fakeout. In such uncertain market conditions, it is advisable to avoid taking any trades and instead wait for a clearer and more reliable trading opportunity. Similarly, in a bearish market, where lower highs and lower lows are forming within a descending channel, the price may eventually break above the upper trend line. When this breakout occurs, we wait for a pullback to the upper trend line. If there are any signs of price rejection at this level, it can serve as our entry point for a buy position. This presents a potential opportunity to catch a reversal from a bearish trend to a bullish trend. However, if the price re-enters the area below the upper trend line after the breakout, it is considered a fakeout. In such cases, it's best to avoid entering any trades, as the price may either resume its bearish momentum or move upward without clear confirmation. Now, let's look at some real market chart examples of breakouts and fakeouts within price channels. In this example, we can see that higher lows and higher highs were forming within an ascending channel. Eventually, the candles break below the lower trend line, and the candle closures beneath the trend line confirm the breakout. However, the following candles move back above the lower trend line, re-entering the ascending channel without providing any evidence of sell at the lower trend line. This indicates that the breakout was a fakeout. It's important to avoid trading in such uncertain market conditions to minimize the risk of potential losses. In this example, lower highs and lower lows are forming within a descending channel. Eventually, the candles break above the upper trend line of the channel. A candle closing above this trend line confirms the breakout. At this point, we wait for a pullback to the upper trend line. If the price shows any clear signal of upward movement, that becomes our entry point for a buy position. Place your stop loss just below the low of the confirmation candle, and set your take-profit target at the nearest resistance level. Thanks for watching, and remember, successful trading involves more waiting than actual trading. Patience and discipline are essential, as following your strategy consistently is key to becoming a profitable trader over the long term. If you learned something new today, don't forget to hit the like button, subscribe for more such strategies, and turn on notifications so you never miss an upload. See you in the next video.